Friday, March 6th, 2020, at the end of a week which pretty much everybody in the mortgage business is glad is over. And I think I would say the same for anyone out there in consumer land who tried to find one of us to talk to. The news media has it correctly that long-term interest rates have reached all-time lows. I mean, in fact, last night, as I do, watching Bloomberg to catch the opening of Asian markets, I watched the U.S. 10-year Treasury note move from its all-time low set yesterday at 0.93%. This week, the first time ever below 1. While I'm reading and saying goodnight to the family, going to 0.8 and then below 0.8 and closed today at about 0.73. Traditional spreads suggest that mortgage rates running 2%, a little more than 2% above the 10-year, should now be at or below 3%. And instead, they rose all week. And the news media is completely clueless, which is reasonable. It's hard to explain. My kids still watch they're in their 30s, one of them, but she loves to watch the Ice Age movies. And there's that wonderful squirrel in pursuit of an acorn. That's the way we feel. If too many people try to get through the same door too fast, nobody gets through. That's just part of the problem. The glue that has held together the whole mortgage machine on Wall Street since 1983, that's when we became Wall Street dependent, has been the ability to hedge future risk that people will refinance or not refinance. It's two risks simultaneously. How can I hedge going up too fast with going down too fast? And a miracle in 1983, a set of derivatives invented in 1983, have worked beautifully ever since. Now they have broken down from time to time, but this is epic. The problem in hedging is it's based on probability math. And so long as future events take place within the confines of backlook probability out to 10 standard deviations from the mean, we don't need to worry about things that might happen otherwise because they can't happen statistically. In a combination of Wuhan, the stock market falling apart mostly because it was overbought, not so much because of Wuhan, the markets for interest rates reached impossible probabilities. And so all of the hedging on which $11 trillion worth of mortgages depend broke down. And when it breaks down, particularly with cascades of refinancing, extinguishing the current mortgage supply, this leaves the people who used to own those mortgages holding hedges, which are losing money because there are no mortgages. And so in desperation, these holders of what used to be mortgages race into the credit markets to buy new things to replace the assets which refinanced out. That's why the 10-year Treasury note has fallen in barely 2 weeks from 1.5 to 0.7. Is this incredible and suicidal panic. Every time one of these busted hedges results in a new order to buy more treasuries, rates fall more, which means that other hedges are busted and they have to race to buy more, which pushes rates down further, which means more busted hedges, which means more people have to buy. And it isn't over yet. The pull-through to consumers, there were moments 2 weeks ago when we could do 3.25% with no points. Today, most of today, there's been some fractional discount point at 3.5. There are whole banks which have dropped out of the marketplace altogether, or priced so high that nobody will do business with them. It's going to take time. I appeal to the public to be patient with us, to tell us what rate would work for you rather than try to bottom fish. No one knows where the bottom will be. For some technical reasons, absolute mortgage zero is probably not very far below 3%. We might get there depending on the Wuhan outcome. So sidebar to Wuhan. The virus itself is not doing economic damage. It's killing people, but it's not doing economic damage. What does the economic damage is hysterical quarantine. I ran into more local people, here in Boulder, Colorado, which is a hotbed of lunacy and hysteria on most subjects. And more people feeling, why don't we just get this over with? I mean, knock it off with the masks and the quarantine, and let's go back to work and go about our business. And could happen. Rates are not going to go back up until Wuhan recedes. Vaccine's a year away, probably. We don't know mortality because we don't know how many people are infected. We don't know because we don't have the test kits, and we don't random test. We don't test the asymptomatic to find out who might be infected but is not symptomatic. And in most of the world, the government authorities would just as soon not know. We're just going to stumble forward here for a while, but apologies to anyone who tried to borrow mortgage money this week, and probably for weeks ahead. If we sound harried, we are. It's hard to explain what it's like to get 50 or 100 emails that you can't answer every day, and another several dozen phone calls from friends and past customers, and you can't answer them either. But hey, it's why it's such a lucrative trade. But I mean the apologies. Have a good weekend.